interrupt the banter. We're very happy to have Carole Comerton-Forde here to present her paper with Barbara Rindi. And Carole, the floor is yours. Just quickly for process, Carole would like to have us, so she takes breaks for questions. So we wait with our questions until the time comes. And, but feel free to ask questions in the chat, and Barbara is also there possibly to answer your questions. Okay, now the floor is yours, Carole.
Excellent. Thank you very much, Andreas, and thank you very much to the team that have organised the Microstructure Exchange seminars. I appreciate the opportunity to present. I haven't attended the meetings up until now, given the hour that they're at for me, but it's nice to be able to see everyone, and hopefully I'll be able to see you again in person sometime in the future. But for now, Zoom is a good alternative. So the paper that I'm going to be presenting tonight is a very new paper. So this is the first time we're presenting it. It's called Trading at the Close, and it's co-authored with Barbara Rindi. The project has been sponsored by the Plato Partnership. So for those of you that don't know Plato, it's a not-for-profit consortium of the buy and sell side in Europe. And their objective is to improve market structure. And one of the things they do on that agenda is to support academic research on topics that they're interested in. So they're interested in understanding trading at the close and how that's impacting markets. I want to start the presentation with two motivating charts, two trends that are very apparent in global equity markets. The first, I'm sure you're all very aware of, that is the large rise that we've observed in the last decade or so of index and ETF assets under management. So over the last decade, those index funds and ETFs have grown from about $2.3 trillion up to $11.4 trillion. And I just saw the FT reported today new numbers for 2020, and that number is now up at $15 trillion. So very large growth in index funds under management. In the US, that has increased from around 21% to 41% over the last 10 years. And in Europe, the growth is not quite at the same level, but is also still substantial, increasing from about 10 up to 20% over the last 10 years. The second trend that I want to highlight, which I'm sure, again, many of you are familiar with, is the rise in the use of closing auctions in equity markets. So these pictures come from a paper published by BlackRock last year. The picture on the left shows us the percentage of activity done in closing auctions in global equity markets. And you can see that number has grown very rapidly over the last 5 years. So grown from around 6% in 2016 up to almost 16% at the end of 2019. And that trend has been apparent in markets, or developed markets at least, all over the world. So you can see the picture on the right, the level of activity on a geographical basis. And the developed markets in Europe have the highest level of auction trading in the world. So those two trends have been linked both in the industry and regulatory discourse and also in the academic literature. So they've been tied together, that index investing is contributing to or causing the rise in closing auction activity. Both regulators and industry have raised some concerns about both of those trends. And essentially the concern is that the rise in index investing is harmful to the market on a number of dimensions. Concerns around concentration in the industry and a lack of competition, with the largest 3 index providers accounting for a very substantial part of the market. There's also been both academic literature and, again, industry discussion around potential problems in relation to corporate governance. So are index funds active monitors of companies? Is there issues associated with their role in corporate governance of companies? And also suggestion that the rise in index investing is potentially harmful to pricing efficiency. The theory being that index investors don't do fundamental research. They simply hold the stocks that comprise the index portfolio and are price insensitive. And so as their activity rises, then there's not enough fundamental research to come up with efficient prices. And the criticisms of the rise in the closing auction essentially relates to that last point, that because index investors like to trade at the close, because they're benchmarked to the close, having high levels of index activity potentially harms the pricing efficiency in the closing set at the end of the day. And clearly, if that is the case, that's very problematic, because closing auctions and the closing price benchmark is a very important benchmark and sets prices in a range of different products, not just for the index funds themselves, but it's also often the price that is used for derivative contracts, is also a price that's used in other types of contracts, both corporate covenants, executive remuneration, and so on. So it's important to understand whether any of these concerns are valid, and if they are, then is there any regulatory action required? So with that background, what we want to do in this paper is try to answer three questions. The first question is the increase in closing auction activity explained by the increase in index ownership, or are there other factors at play? And then, has the growth in closing auction activity made closing prices less efficient? And then finally, has the growth in closing auction share impacted liquidity or pricing efficiency during continuous trading periods? With the thinking being, if a lot of activity is shifting from continuous trading into the close, does that mean the prices that get discovered during continuous trading are less efficient? So the context in which we're going to look at those three questions is the context of the European markets. As I said, Europe has the highest level of closing auction activity, so we think that that's an appropriate venue to consider. We're going to look over the period January 2015 through to April of 2020 in index stocks. Over our sample period, closing auction turnover has increased by around 45%. And over the same period, total market turnover has actually declined by about 5%. And that decline has been quite substantial in continuous lit markets. So about a 24% decline in activity executed in lit continuous trading venues. So over our sample period and in our sample stocks, the closing auctions are very significant. They account for about 25% of primary market turnover and approximately 10% of consolidated turnover across all of the different trading mechanisms in Europe. Unlike the US market, the auction mechanism in Europe is a little bit different. There is a pause between continuous trading. So typically a 5-minute pause, during which time you go into a pre-call period where orders can be entered into the market and amended, but there's no execution. And then at a designated point in time, there's a multilateral matching of all the orders that are interested in it being executed in the auction. So to summarize our results, firstly, we find evidence that index investing does not explain all of the increase in closing auction activity. So over our sample period, the index growth has been much more modest than the growth in closing auction activity. So it's gone from about 5.7% of the market to 7.6% of the market. So a growth rate of about 25% in the context of that 45% increase we've observed in auction turnover. That's perhaps not that surprising, given that index funds typically trade only on or predominantly trade on rebalance days. So they don't want to change their index portfolio other than when the index rebalances. So we would expect index activity to be concentrated on those rebalance days. But what we find, interestingly, is that the growth rate in the use of auctions on non-rebalance days is approximately the same as it is on rebalance days. So while the level of activity is much higher on rebalance days, the growth rate is about the same on both rebalance and non-rebalance days. We show that auction activity increases with turnover and volatility, and also with index ownership and on rebalance days. When we think about the efficiency of the closing price, we think about the absolute auction return, which we measure as the difference between prices observed in continuous trading compared to the auction price itself. And what we find is that return is quite substantial. So on average, the absolute difference between the auction price and continuous trading price is about 15.9 basis points, with a median value of about 12.2 basis points. And those auction returns are even bigger on index rebalance days. So 22 basis points on MSCI rebalances, almost 27.5 basis points on country index rebalance days. Those auction returns also increase with auction turnover, volatility, and index ownership, and decrease with size and continuous turnover. So are those auction returns driven by demand and supply imbalances, or are they permanent price changes suggesting that the auction is an efficient price discovery mechanism? What we find is that those auction returns are mostly permanent. So on average, there's less than a 30% reversal from the auction price to the open the next day. And where we do observe significant reversals, they tend to happen just in 2019 and 2020. We're reluctant to point to that as being a trend, given that 2020 had some rather unusual events, and given our sample ends in April, we're picking up really the most extreme volatility in the market. So that's an important consideration. What we find is that most country year observations have no significant reversals overnight, suggesting that the auction is in fact an efficient price discovery mechanism. We confirm that by looking at monthly variance ratios. So we don't find any evidence that closing auction prices are less efficient than prices observed at other times during the trading day. And then finally, our last set of results is that if we look at market quality during the last 30 minutes of continuous trading, we find no evidence that either intraday price efficiency or bid-ask spreads are affected by the high levels of auction activity. And we in fact find some evidence that order book depth improves with auction turnover. So I might take a break there and answer any questions before I dive into the details.
So there were a few questions about cyclicality, but I think that you have already answered them. I'm wondering, are there any other questions at this point? So maybe can I ask a question then? So you
Sure.
say that there's a pretty high return on average on these auction on the closing auction. So there's two questions I think that arise right away. One is there any predictability, for instance, since the depth is larger, order book depth is bigger, or is sort of indicative of the volume? Is there any directional view that you can have? And then the second question I have is one of the risk-return trade-off. So is it also that there's a very high volatility in the auction price relative to the continuous market price that would explain the return?
Yeah, so we haven't actually looked at predictability. That would be something worth doing. The auction return is in fact related to stock volatility. So stocks that have higher realized volatility also have higher auction returns.
Okay. Anybody else has a question? Well then, carry on.
Okay. Okay, so what I want to do through the rest of the presentation is firstly highlight some of the relevant literature that we're building on. I'll talk in some detail about our sample and the data that we're using for the analysis. And then for those not familiar with the European equity markets, I'll spend a little bit of time talking about the European market structure and also the auction design. And then I'll give you some more detail of the trends in trading over our sample period and the trends in index investing. And then I'll walk through in more detail the three sets of results. So what determines auction volume? What determines auction returns? And do we find evidence of reversals or any change in the variance ratios over our sample period? And then finally, what happens to intraday market quality? So we're building on a large body of literature which has shown us the benefits of call options. So dating back to the late 80s, early 90s, there were a number of papers that contrasted auctions against other trading mechanisms, whether they be continuous limit order books or dealer markets. And that literature suggests that auctions offer benefits by bringing together multiple counterparties, having multilateral matching of orders. That can lead to benefits in terms of greater liquidity and more efficient prices. Closing auctions really became the most common form of closing markets beginning from the late 90s. So since the late 90s, most developed markets around the world have adopted closing auctions to set their closing price. And as that transition happened, there are a number of papers studying the impact of closing auctions on pricing efficiency and trading costs. And again, that literature points to closing auctions offering benefits in terms of reducing the possibility of manipulation in prices, reducing trading costs, and generally making closing prices more efficient. The contemporaneous work that's most relevant to us is two papers from the US market looking at, again, the rise of auction activity in that context. So Vincent and Dimitri, I think, presented their work in this forum last year. They find evidence similar to us that auction returns are substantial, although not as substantial as what we observe in Europe. But their results are quite different from ours in that they find those returns are reversed the next day. So they find some evidence that the auction distorts closing prices and that the midpoint price observed at the end of the trading day is more efficient than the auction price, which contrasts with the results that we have. We speculate that the difference in results comes from the difference in the auction mechanisms. Of course, the US markets don't have that pause in trading between the end of continuous trading and the auction itself. People send their orders to the auction as continuous trading is going on, and the auction happens immediately after continuous trading ceases. So our expectation is it's the institutional detail that drive the differences, but of course we're not looking at the US market, so we can't pinpoint that directly, but we do think that that's the key difference in the drivers of our respective results. So sample and data. So as I said, we're looking at 6 European markets. So that's the UK, France, Germany, the Netherlands, Italy, and Switzerland over the period January 2015 to April 2020. We use all of the stocks in the main index in each country. So that's a different number of stocks in each country. So in the UK, that's the FTSE 100. In France, it's the CAC 40. Germany, it's the DAX 30, and so on. But that gives us a sample of 285 stocks that were in the index at some point in time during our sample period. We get data from a number of different sources. So we get primary market trade and quote data from the Refinitiv tick history product. And we get that just for the first and last hour of continuous trading, plus the auction as well. And then we also gather daily turnover information, both from the primary market, which comes from Refinitiv, and consolidated turnover, which we get from the Fidessa regulator. So the European markets don't have a consolidated tape in the way the US market does, and that's a highly contentious issue. But the Fidessa regulator is a pretty comprehensive set of turnover information across all of the alternative trading mechanisms that are available in the European markets. All prices are converted to euros. We also identify index rebalance dates for both the MSCI and the country-specific indices, and we get those from the index providers. And then finally, we get monthly data on ETF and index ownership of the stocks in our sample from FactSet. So a little bit of context in terms of the institutional detail of the European markets for those not familiar with that. Trading is governed by a set of regulations known as MiFID. That was in place from 2007 through to 2017. In January of 2018, there was quite a big change in the European regulations, now governed by MiFID II. The most substantial of those changes was a ban of some types of dark trading, and also the introduction of a new, not a new mechanism, but there was a substantial increase in the use of systematic internalizers. So systematic internalizers are investment firms that, as the name suggests, internalize order flow against their own capital. So trading in the European markets is fragmented across a number of different types of venues. So firstly, across the primary markets, which are the listing venues. Also across multilateral trading facilities, which are similar to ATSs in the US context. So they operate both lit and dark trading venues using, typically limit order book technology that's very similar to the primary markets. Then we have the systematic internalizers who are internalizing order flow against their own books. Periodic auctions, which are akin to the high frequency batch auction described in Eric Budish's paper. And then finally, off-book trading, which is essentially OTC trading, which just gets reported to an approved publication venue. So we gather information from all of those different types of mechanisms through the Fidessa data that we use. European markets don't have a trade-through rule. So brokers are not required to connect to all the venues available to them. They can choose which venues they want to trade with and which ones they don't want to. Order routing decisions are governed by best execution obligations. The best execution framework is a principles-based approach. So the broker sets out what criteria that they're going to use in terms of making their order routing decisions, and then must demonstrate that they execute orders according to those principles. Trading opens and closes with a call auction, and those auctions are operated only by the primary market. So just to give you some detail on how those auctions operate, so I've taken a snapshot here for Euronext. All of the markets in our sample operate under the same principles. There is some variation in the timing of their auctions. So in our analysis, we line up the timing, even if they're not taking place at exactly the same time, we line them up and look at fixed increments from the auction. So essentially, what happens is that continuous trading stops. Then you go into a pre-auction call period, which is labelled there as the deterministic call phase. So during that time, brokers can send orders to the market and amend their orders. and price discovery is taking place, then the auction will occur a single multilateral matching of all orders. The timing of those executions is randomized. Anywhere from 30 seconds to 2 minutes is the randomization time, depending on the market. And the objective of the auction algorithm is to maximize the volume traded and minimize any surplus volume. And if those criteria are not enough to determine a unique auction price, then they also consider the demand and supply imbalance in the order book. So that auction is intending to maximize the trading that can take place at the end of the day, and hence attracts a lot of activity. The randomization is intended to reduce the possibility of gaming and manipulation in closing prices. And some markets also have volatility extensions, which are again intended to reduce the volatility associated with the auction price. Just one remaining piece of institutional detail that is relevant for our work is that derivative settlement prices are not tied to the closing price in any market in our sample. So different markets use different mechanisms to determine the derivative settlement price. The UK and Germany have a special intraday auction. France and the Netherlands have a predefined period during continuous trading where they set the derivatives price, and Italy and Switzerland use the opening prices. So what that means is that derivative settlement should not be driving behaviour at the closing price in any market in our sample. So turning to the trends in trading activity during our sample period, this just gives you a sense of the monthly turnover over our sample in aggregate across the pan-European sample. And you can see that even with that huge spike in March of 2020, on average, the total activity in the European markets has declined by about 5% from the first year compared to the last year of our sample. That decline, as I mentioned in the beginning, is even more substantial in the continuous market. So there's been a move away from continuous trading and a big shift towards the auction. So a 45% increase in auction activity over our sample period. The orange slice of the picture there is the systematic internalizers. So you can see when MiFID II was introduced in January of 2018, that led to a big uptick in the level of activity in the systematic internalizers. That's not particularly relevant for our analysis, but I just highlight that given that it's quite a big shift in the allocation of trading across markets. So focusing in on the closing auctions, they clearly are a very significant liquidity event. So 2 lines on this chart. One is telling us the level of auction activity scaled by primary market turnover, and the other is the level of auction activity scaled by consolidated turnover across all of the different trading mechanisms. So it's obvious from this picture that the closing auction is a very important liquidity event for the primary markets. They are doing close to 25 or 30% of all of their trading in those auctions. But it's also significant overall in terms of the overall activity in the market, and it has been growing quite substantially over our sample period. Okay, so what's happened to index growth in our sample period? It has also grown quite a bit. So we've had about a 25% increase in the level of index ownership in our sample, but that's considerably less than the growth in auction activity. So perhaps something that's worth pointing out and is probably known to everyone already, but worth thinking about, index funds obviously have much lower portfolio turnover than active funds do. So BlackRock reports that On average, index funds turn over about 7% of their portfolio each year, compared to 80% turnover for active funds. So if we're thinking about the contribution of index funds to trading activity, their contribution to trading activity is much lower than it would be suggested by the level of index ownership that we observe. And Vanguard reports for the US market that index trading activity only accounts for about 5% of all trading in the US market, where the level of index activity is much higher than Europe. So we expect that the overall level of index trading in the European market is quite a lot less than that. As I mentioned in the beginning, we do expect index funds will be more actively trading on rebalance days. And we do in fact find strong evidence of that. So the level of activity in auctions is much higher on rebalance days, both MSCI and country index rebalance days. So the thing that I think is most interesting about this picture is if we consider the growth rate of auction activity on rebalance days compared to non-rebalance days, they're approximately equal. So over the sample period from 2015 through to 2019, so we'll ignore 2020 for a moment, auction activity on rebalance days has gone up 40% or 50%, depending on which index we're thinking about. But on other days, so non-rebalance days, that has gone up about 50%. So if the closing auction increase was attributed only to index investing, then we would expect the growth rate on those other days to be much, much lower, but it's not. 2020, of course, seems like somewhat of an anomaly. It reverses the trend. I think this reflects the fact that, particularly in February and March of 2020, the market experienced extreme volatility. Traders were reluctant to defer their activity to the auction. They wanted to trade when they could during continuous trading. So we see a big drop-off in the level of auction activity during that period. We do want to extend our sample, and I suspect if we consider the whole of 2020, we won't see such a big decline in auction activity. All of these patterns are consistent within individual countries as well. So if index investing is not driving all of this increase in auction activity, what else might be at play? So the obvious first thought would be ETFs, but there's some work from JP Morgan modelling the level of ETF activity in the European markets, which suggests that that's not enough to explain the rise in auction activity that we observe. Some other possibilities have been floated. One is there's also been an increase in systematic and quant strategies. Those types of strategies are also frequently trading index stocks, but not just on rebalance days. And they also like to trade at the close. So that may be a contributing factor to the growth in auctions. Capital requirements imposed after the financial crisis have made banks much more reluctant to carry positions overnight. So potentially some of this activity is banks closing out their intraday positions in the auction. MiFID II strengthened the obligations in terms of best execution in the European markets. And so we think the closing price has become a more important benchmark as a result of that. So that may also drive increased auction activity. The French regulator has produced some work showing that high-frequency traders tend not to participate in auctions. And so that may also be a factor. Natural investors wanting to find other natural counterparties will aim to find that liquidity in the closing auction. And then also increased adoption of algorithmic trading tools In particular, market on close orders have been incorporated into many algorithms, and they're in fact market on close algorithms, and participation algorithmic strategies increasingly included the close in their activity or in their logic. And that becomes somewhat of a self-fulfilling prophecy, as if you're trying to participate with volume, as that activity increases, people have to participate more in the auction. And that idea is also consistent with the early work of Edmardi and Fleiderer around liquidity begets liquidity. So if everyone knows index investors are going to trade at the close, it will be an attractive liquidity event, attracting discretionary liquidity traders as well, and also informed traders, trying to find that plentiful liquidity, and also perhaps trying to hide in the crowd provided by the index investors. So we don't at this point explicitly test those alternative explanations, but we would like to do some more work to try and tease out some of those other drivers for auction activity. So turning now to some of our more formal empirical analysis, most of the work that I'm going to present is basically looking at stock day level variables, and we're going to look at the association between a number of auction measures and how they relate to the rebalance days, to index ownership, and other control variables which we typically see in the literature. So our regressions typically take a format like this. So in this instance, looking at the determinants of auction turnover, that's going to be regressed on those variables I've mentioned, the MSCI, country index rebalance dates, index ownership, and a bunch of control variables. All of our regressions have got stock fixed effects and standard errors clustered by stock and by date. So I'm going to, obviously, I can't fit all that information on a slide, so I'm going to report the coefficients for the variables of interest, but the regressions do have those other control variables as well. So turning first to the determinants of auction volume, we can see that auction volume is positively associated with continuous turnover. So a 1% increase in continuous turnover leads to a 4.5% increase in auction turnover. MSCI and country index rebalance dates, consistent with those figures I showed you, also substantially increase auction turnover. So we have between a 70 and 100% increase in auction turnover on those days. Interestingly, those rebalance days are also days with higher or lead to higher continuous turnover as well, but the economic magnitude of those increases is much lower. So traders are also trading more during continuous trading during those days. We also see that a 1% increase in index ownership also is associated with a 1.1% increase in auction turnover. Okay, so now that we have some sense of what determines the auction volume, what determines the absolute auction returns? So the main measure we're going to use here is we're looking at the log return between the closing auction price and the last midpoint price immediately before the continuous trading period ends. When we look at that return, as I mentioned, those returns are quite substantial. So on average, there's a 15.9 basis point auction return. Those results are much larger than what's been observed in the US market, where the average is, using an equivalent measure, is around 8 basis points. We also consider some alternative benchmarks to calculate that auction return. So rather than looking at the last midpoint price, we look at the midpoint price 5 minutes before continuous trading closes and 30 minutes before continuous trading closes. And I think consistent with what you'd expect, the magnitude of those returns is bigger. All of our results, though, are qualitatively consistent regardless of which of those auction return measures we use. So again, first considering the results in terms of pictures, what we can see is that auction returns are also much higher on the index rebalance days. So approximately 40% higher on the MSCI days, 73% higher on the country index rebalance days. Again, 2020 is quite an outlier, again related to the extreme volatility observed during our sample period. Those auction returns are much, much higher. But apart from that anomaly in 2020, we really don't see any particular time series trend in terms of those auction returns are not getting bigger as the auction turnover is rising. And again, those results are consistent when we look at the individual country contributing to the sample. So again, more formally analysing those results, we find that a 1% increase in auction turnover is associated with an 8.6 basis point increase in that auction return. Interestingly, when continuous turnover is higher, the auction return declines. Surprisingly, we don't see any statistical significance on the rebalance days. And if we take the auction turnover out of this regression, those coefficients do become significant. So it's the combination of the increased auction activity associated with those rebalance days that is contributing to those increase in auction returns. Index share is also positively associated with the auction return, but the economic magnitude of that association is pretty small. So only a 1% increase in index share leads to only a 0.19 basis point increase in the auction return. So compared to the magnitudes on the turnover and on the rebalance days, that number is relatively small. So is that large auction return we're observing, is that reflection of auctions dislocating prices, or is it reflective of auctions being an important price discovery event? So two possible explanations. First, the auction return is caused by large demand and supply imbalances, which means that there's a temporary dislocation in the auction price. Or the second possibility is that the aggregation of liquidity at a single point in time, where we're concentrating close to 20% of primary market activity at that point in time, is an important price discovery event leading to permanent changes in prices. So if scenario 1 is in place, then the prices should reverse the next day. If scenario 2 is in place, then we won't see the returns being reversed. So to test that, we regress the overnight return on a signed auction return. We use two different measures of overnight returns. So we've considered the overnight return from the close to the open the next morning. Or if you think the market needs a little bit more time to reach an equilibrium price after the open, we also consider a later point in time, so 5 minutes after the open, we capture the midpoint price. So if we observe reversals that are close to -1, that would suggest the auction return is driven by demand and supply imbalances. But if that reversal is close to 0, then it implies that the auction is setting an efficient price, and therefore the auction is an important price discovery event rather than one that distorts prices. So to summarise the results, what we've done is just to plot the statistically significant coefficients across our sample, so both by year and by country. The red bars are for the pan-European sample. So if we focus on those first, what you can see is that across the whole sample, we do have a statistically significant reversal, but it's only about 30% of the auction return gets reversed the next morning. That result is coming from 2019 and 2020, and in particular 2020. So again, perhaps it's this high levels of volatility associated with COVID that is driving that result in 2020. But in the first 4 years of our sample across the pan-European universe, we don't get any statistically significant reversals. So this figure is reporting reversals using the close to open return and the auction return based on the last midpoint price and the auction price. If we consider an alternative specification, so where we now consider the longer horizon in terms of the overnight return, and also a slightly longer horizon for the auction return, so where we're measuring the auction return relative to the midpoint price 5 minutes prior to the close, you can see that the frequency of reversals becomes much more sparse in terms of statistical significance, and also much smaller reversals as well. So we have fairly infrequent incidences of auction returns being reversed, and when we do, they're relatively small in magnitude. So around 30% of the return is being reversed. So our takeaway from that is that the auction is actually a very effective price discovery mechanism. So in addition to providing and offering substantial liquidity to investors at that point in time, it's also contributing to price discovery because those prices don't get reversed the next morning when continuous trading resumes. We test that using an alternative measure. So considering variance ratios. So the large body of literature on auctions has frequently used variance ratios or daily variance ratios to measure the pricing efficiency of a particular trading mechanism. So the thinking being, if we measure returns over a 24-hour period, they should be, the variance in those returns should be the same regardless at what point in time we measure those returns. So if both the close and the open have equivalent levels of pricing efficiency, then we should observe a variance ratio of 1. So we consider 2 different measures of variance ratios. The first one is the close to close and open to open. And the second one is the close to close relative to the last midpoint price. So that's the L to L measure. What we find is that on average, the variance ratios observed in our sample are not different from 1. And then we calculate those variance ratios on a monthly basis, and then estimate a regression where we look at the variance ratios on a monthly basis against each of our variables that we've looked at in the earlier regressions. But of course, now these measures are estimated over a monthly basis. So our MSCI and country index rebalance days, rather than being days, these are MSCI and country index rebalance months. We want to understand whether the variance ratio in a rebalance month is different from non-rebalance months. Looking at these results, you can see a dearth of statistical significance. So we don't see much evidence that the turnover in the closing auction is influencing the variance ratio of the closing prices. We do see some statistical significance on the close to close and the last to last variance ratio. On the MSCI rebalance days, it appears the closing auction is becoming slightly more efficient. On the country index rebalance days, it's becoming slightly less efficient, but the economic magnitude of those changes are quite small. So I might take a brief break there for if there's any questions before I move on to the intraday analysis.
Oh my God, Carole, you know you have only 10 minutes left, and there's a ton of questions there.
Yes.
If you don't mind. So it's a little difficult to go through all of them. Maybe we can start with Björn, because he has a question about the negative relation. Maybe Björn, ask a question yourself.
Yes, actually, Francesco clarified to me that they have stock fixed effects. My question was whether this correlation between continuous trading turnover, it had a negative correlation to the closing auction turnover. So I was wondering if that comes from the time series or if it comes from the cross section. I understand you have fixed effects for the cross section.
Yeah, so it's coming from the time series.
Interesting.
Milena, do you want to ask your question?
Sure, yeah. So I was wondering whether your data, and I missed that, allows you to look into whether your results between the two trading mechanisms is driven or might be driven by a selection of traders, the type of trader that selects into continuous trading or the auction, if that's possible, and if so, whether you looked into it.
So the short answer is no. we don't have data that would enable us to do that, but obviously that would be something that would be nice to be able to understand. As I alluded to at the beginning, the French regulator has done some work looking. They do have data that looks at trader type, and they show that high frequency traders are much less likely to be in the auction. And have some additional insights on that, but unfortunately we don't have any data like that. I would expect that the results observed in the French market probably hold everywhere, but unfortunately we can't explore that.
So I want to quickly pick up on Milena's question there, because if you think about what happens in the last 15 minutes or so before the auction, if all price discovery actually were to happen in the auction, then it's quite risky to trade at the very end, isn't it? So do you have any indication of that there is a higher bid-ask spread or the likes, or something that would justify or that would capture that risk that people face that want to trade that late?
Yeah, so that's actually the next piece of analysis that I'm going to present. So should I maybe just go straight on to that? I think
we want to. I think there's so many questions. Actually, I would like to get a little bit more discussion, but going. But I'm,
okay.
You're the one who is almost at 2 a.m. at night, so it's really up to you. Because I would like.
So why don't I very quickly touch on the answer to your question? I won't go through all the results. I'll just say that the intraday patterns in the European market are very much familiar to what you would expect in the US market. So, we've got J-shaped turnover, a reverse J-shape in terms of spreads, depths build up through the day. Over our sample period, we do see trading shifts away from the end of day. So that last 30 minutes of activity shows quite a big drop off in volume. So to your point, if it's more risky to trade in that last 30 minutes, do they defer? And it seems that is the case, and that decline becomes steeper in a shorter window. So over the last 5 minutes, that decline is proportionally bigger. So we do try to explore that what happens to intraday bids, so spreads and depth, and also intraday pricing efficiency. This is the area of the paper that needs the most work. At the moment, we have a two-stage least square regression where our instrument is simply lagged closing auction volume. Obviously, that's not the ideal measure. We want to expand the sample and look at the changes in the index composition and use that as an instrument instead. But just to sort of very quickly summarize what happens to spreads and depths. So we've got a normalized spread measure and a normalized depth measure and a normalized pricing efficiency measure over the last 30 minutes of trading. And what we find is that there's not a lot of evidence that either spreads or pricing efficiency are harmed by this shift to the auction. And we find some evidence that depth actually is enhanced by the shift to the auction. So there's more volume coming into the book at the end of the day, although that does decline somewhat on those rebalance days. The net effect seems to be that depth in the continuous market improves as, I guess, traders send their order to the market in anticipation of wanting to trade in the auction when there's plentiful liquidity. So there's a bunch of things we want to do to further expand our work. Maybe in the interest of time, I won't go through those, and I'll just instead just wrap up. So overall, we think our evidence suggests that closing auctions are not just an important liquidity event, but also an important price discovery event. We don't have evidence to suggest that we should be concerned about the growth in auction activity. And we think the difference between our results and those in the US point to some benefits in the European auction design, which might be effectively implemented in the US markets to improve pricing efficiency at the close in that marketplace. So yes, you're right, Andreas. It would be good to get some more questions.
Yes. Well, I'm sure there's many takers. Maybe we talk to Michael Goldstein, has a number of questions, and then you can go for that. Michael, go ahead.
Great. You're muted, Michael.
Yes, of course. And you're the one who's up late. I guess it's great, very interesting. Do you think there's any chance that the continuous markets information is worse because is there any chance that the returns are higher in the days when there's more going on in the auction and that information had been drawn out of the continuous market, so that in some sense more activity in the auction is hurting the price formation prior to it?
Yeah, that's a good question that I don't have a convincing answer to, other than the rebalance days. I think it would probably be useful to also look at high information days and to see whether there's differences coming on those days, but that's not something that we've done at this stage, but would be useful to consider, I think.
Right. Okay. I'll send you some ideas offline.
That'd be great.
There's also
Thanks,
a very
Michael.
active discussion here between Jim, Pete, and Joel about fees and the impact of fees. Maybe you want to, I mean, I'm not sure if any of them wants to step up and ask a big question, but I think there's a question of whether or not the fees differences could drive the different usage, in particular also both within Europe, but also across from Europe to the US, which obviously you didn't do the analysis for.
Yeah, so I will say on fees that auction fees are quite a bit higher than continuous trading fees. And the European regulator recently had a consultation asking participants whether they were concerned about the growth of auction activity. And the answer that generally came from the buy side was, no, we're not concerned, but we are concerned that exchanges have a monopoly on the auction. The auction is an important price discovery event, and the regulator should look at fees in relation to auction activity. So I do think that that's an issue, but it seems that certainly the exchange in Australia run the line, we charge high fees because this is a premium product and you need to pay premium fees for the premium product. So I suspect the European regulators would run the same line, and the fact that so much activity has shifted there would perhaps support that position, but definitely something worth thinking about.
Well, so if I may chime in on that one, there's also a question of actually who pays the fees, right? Because and what options brokers offer their customers, right? So if customers actually have the choice to pick the close, and so then they may actually choose that because they may feel like they have less adverse selection at the time, because they trade per se as you actually show at the fair price, right? Whereas there is a question of whether or not that fee is also passed on to the customer. So this is always, I think it's always a tricky one to describe, right? Who puts the trade, actually, who pushes the trade to the close? Is it the customers or the brokers?
Yeah, no, I think that's a good point. And I see in the chat, Ed has commented on the fact that there are now alternative auction products in the European market. So some of the MTFs offer a trade at close mechanism. But there's no price discovery in those mechanisms. It's just being able to trade at the closing price, and they typically attract lower fees. And also the systematic internalizers have also offered guaranteed trade at close fills as well. So they're both things that we would like to explore further in our analysis, but haven't done that yet.
Now, again, I don't want to hug the discussion, but can I ask one more question, which is, so you have this result where you show the absolute deviation of the price, so the expectation, so the average, yeah. So I think that's the measure that you're using, which I'm wondering is, I mean, you know, so I'm not as firm as I should be on these things, but it seems to be more of a dispersion measure rather than a return measure, right? Because I mean, the return would be the average of those, right? And so I'm wondering again if there's a risk story there rather than, you know, a return per se story.
Yeah, no, you're right. It is a dispersion, but I mean, I guess we've labelled it a return because we're thinking about, does that change in price get reversed the next morning? But that's definitely worth thinking about further too.
Joel, go ahead.
Thank you, Carole. That was very interesting. I'm curious more. I teach the auctions in the U.S. We have a number of features that are aimed at ensuring or stabilizing the closing price. For example, there are submission and early cancellation deadlines. There is limited information that's released during the price formation process. And also there are stabilizing orders, so-called imbalance-only orders. The Europeans seem to rely mostly on randomization of the clearing time. Do they use any of these other features as well?
Yeah, so I see Bjorn's got his hand up. He might be wanting to answer that question for me. He's done some work on volatility extensions in the closing mechanism, so I might let him talk to that. But so the auctions are relatively transparent. They publish the sort of indicative auction price and indicative auction volume and imbalance. I'm not aware of there being any functionality like the US markets where you can stabilize the price, or you've got particular order types that are just responding to imbalances. But we should definitely do some more drilling down into that pre-auction period to understand that better.
Does anybody have a last mover advantage?
I don't believe so.
I should say
That's
this, so we're already past noon, so the official part is over, and anybody wants to drop off should feel free. I presume that Carole wants to stay on a little longer to have a further input and further questions.
Yes, please.
Don't forget, is the normal protocol that I stop recording now, or would I just keep the recording running?
We usually keep it on.
Okay, good. All right, okay.
Keep it running.
All right, good.
So
right,
let me just, it wasn't the reason I raised my hand, but I can just fill in on the answer for Joel's question. All European markets have to have some sort of mechanism to avoid volatility at the close. And the one mechanism that I wrote a paper about is called auction safeguard. It means that if the auction execution would imply that the return since the close of the continuous market exceeds a certain threshold, then the auction batching period is extended by a couple of minutes. And then when you reach the end of that couple of minutes, then it's reevaluated to see if the but with I think then with wider thresholds, so sort of to let the participants reconsider their order if it turns out that this auction is moving the price quite a bit. I had a question that is not related to that. One of the standard motivations when writing a paper on the closing auction is that the closing auction price is used for derivative settlements. I jumped a bit when I saw your note there that none of these auctions are actually used for derivative settlement. So I was wondering if you had a chance to follow up what might be behind that, if there is any documentation on why they have picked other pricing mechanisms for their settlements. That would be interesting.
Yeah, so actually we haven't followed that up, but I know in the Australian market, which uses a very similar sort of auction mechanism, they made a choice quite a number of years ago to decouple the closing auction price from the derivatives expiry because of the fact that it was contributing to volatility in the closing prices. And because the closing price is so important, they wanted to separate the price used to determine the derivatives expiration and the price used for other purposes. So I would guess that the motivation in Europe was fairly similar, but we should probably hunt that down and understand when those changes were made and why they were made. Thank you.
So I think Joel had his hand up first.
Yeah, I just the opening auctions, do they follow the same procedure? And what is the relative volume at the open? Has that also grown?
No, so opening auction volume has actually dropped off over time.
It's the same procedure.
Same procedure,
yeah, okay.
But it used to be that opening auctions were very substantial liquidity events, but that's much less the case than it used to be.
And another question, the market makers in European exchanges have certain obligations. Do those kick in at the close as well, particular for handling volatility?
That's a good question. I don't know the answer to that. I think the answer is no, that they're not obligated to make markets in the closing auction, but we should check. We should check on that.
I can confirm, Carole, that they have no obligation whatsoever to set the market at the end of the closing auction, as opposed to the US, where I guess designated market maker can actually also send in orders which do not absorb the imbalance in the NYSE stock exchange.
I see Ed's got his hand up. He might have an answer to that question.
If I may interject, Carole, 1 second, Ed, before you, because Carl John has had his hand up for longer than you. Sorry.
Yeah, no, I just thought Ed might answer that question as a European market maker.
Ed, if you want to answer that, then you go ahead.
Yeah, exactly. Hey, I'm from Optiver. We're a market maker. There's actually, most exchanges don't have obligations in the close, but a couple do. Deutsche Börse does, actually. So it might be something to look at if they have a different outcome, because they do actually have some requirements in the auction.
Which exchange do have this?
Deutsche Börse, Xetra.
All right. So on Xetra, there are market makers who have obligation at the close.
Yeah, also in the open and their intraday auction. Yeah.
Well, but is it for a special segment of the market in which you have specific stocks in which you have a designated market maker and not for all the stocks? Is that correct?
That's correct. It's their designated sponsor program. And so that applies only to some stocks. I can't remember from the top of my head if the DAX index components it applies to or not. But it does apply to foreign shares, ETFs in those markets.
Right. For the time being, we only have the most liquid stocks which belong to the DAX index. I'm not sure that these stocks belong to the DAX index, but we will certainly check. Thank you.
Yeah, I can double check the rules too and follow up.
Yeah. Christian just posted the answer to that in the chat actually.
Okay, thank you.
Yeah.
Anyway, Carl John, go ahead.
Thank you, Andreas. So the have you looked at the OTC market trading in equities market in Europe? Because I know that the OTC share has increased from 4% in 2017 to 15%, and this may be related to index trading because index fund may find it better to trade over the counter, and that is also consistent with the overall volume of the continuous lit market dropping during the same sample period. So I wonder if there's something that you can look at.
Yeah, that's a good suggestion. Thank you. So yeah, we do have total turnover broken down by the trading mechanism type, and OTC is one of those mechanisms. We have looked at that, but it didn't make it into the final cut for this draft. And I don't actually remember off the top of my head whether there was any evidence of the OTC activity increasing, although we only have that data at a daily level, so we can't observe whether the OTC activity is happening after the close and at the closing price. But that would obviously be something that would be useful to explore if we could. Thank you. So
I personally stopped following the chat, but if anybody wants to ask another question, you could just go ahead and raise your hand or start talk right away. Nobody?
I just wanted to say something about because there was a lot of question about fees, and I was also curious about how fees interact with these increasing closing auction volume in Europe. Roughly speaking, fees are the same in continuous auction and in closing auction for all the European countries we looked at, but the way they set the fee may differ. Some of these countries set the fees in basis point, in value, other countries in trades, on trades. So depending on what happened in the closing auction, one country or the other may become more expensive. So for example, if the size, the average trade size in the closing auction goes up, then the fees trading there becomes more expensive if it is value traded. So roughly speaking, France turns out to be the most expensive at the close, if you follow this line of reasoning. And France is one of them with the highest closing auction volume, which is why I was thinking, not sure 100% fees play an important role in this matter.
Well, one thing is notable is that it's usually the listing market that runs the closing auction, right? So, so you almost have, I mean, you could argue that they have some sort of monopoly on that one, right? And so that would actually, you would imagine that they could charge higher fees for the auction. But as you say, if the net fee is the same, then
yeah, they get more money anyway, because those who actually charge in values, because the average trade size increases in the closing auction, they get more money. But they don't officially charge a higher fee in the closing auction.
Okay, maybe Jim, do you want to go?
Sure, I just wanted to put out a comment. First of all, this is really interesting work, Carole. Excellent, well done. Thank you. Yeah, I think we need to be careful on conclusions, basically, when we talk about the impact on price discovery, because it looks like on average auctions work most of the time. There's some reversals, as you've documented, but every once in a while they can really misfire. And we saw a classic example of this with the Tesla addition to the S&P 500 in the United States, where the auction price was $20 a share higher than the pre and post trading in Tesla right around the auction. So I know some of us fellow disciples of Robert Schwartz tend to think auctions are the answer to everything, but one of the things I learned at NASDAQ when I was working in their opening and closing auctions was just how many different design parameters there are in an auction. Not all auctions are alike. There are dozens of different design decisions that go into them, and every one of them can be gamed in one way, shape, or form. So I think we need to look not just at auctions as auctions, but delve more deeply with our microscope or our microstructure scope into the details of how we run the auctions.
So are you suggesting there, Jim, to look at days that have the misfires, or just to think, yeah, okay.
Yes. I mean, look at the tails of the distribution, because that I think will give you the most interesting results.
Mm-hmm. Okay. Thank you.
Michael?
Oh, hi, hopefully you can hear me. I wanted to ask questions about reversals. I want to start off by saying I'm scared to ask in front of everybody because I get the feeling this is going to be a dumb question. But the graph on reversals, which I thought might have been percentage of time, I was kind of expecting to be 50%. I would have thought if the price was perfectly accurate the night before and then you had news come in and news was truly random, that half the time you'd have a reversal and half the time you wouldn't. And that got me really thinking about, oh, I wonder what my expectation should be about reversal. So here's an idea, probably a stupid one, but so my first thought was 50% and the average reversal is 0. But another idea would be to grab like the noon price and pretend it was the auction and see what percentage of time, what reversals you get using the measure, pretending that was the price. And just to get I guess I don't have a good feeling beyond 50% and 0 for what a reversal statistic should look like. And maybe it'd be helpful to give us a feeling and then give us a feeling how much it varies under different scenarios. But anyway, it was just more of I looked at those reversals, I thought, oh, they're fewer than I was expecting, but maybe I misunderstood.
Yeah, so the graph was actually the sort of the magnitude of the average magnitude of the reversal. So on average, 30% of the return was getting reversed. But I think that's a good suggestion, looking at the frequency with which you get a reversal. I guess the question is how to define what is a reversal. So do you need a 100% reversal to call it a reversal, or is a 80% reversal adequate? But I think that's worth thinking through, because I agree with you. Understanding the frequency with which you get a reversal would give us another insight into that issue. And I guess that's probably related to Jim's point as well, in terms of, do you get are you more likely to get a big reversal if you had a Tesla type event where the auction return was crazy, or do you see reversals mostly when there's not much of a difference between the continuous price and the auction price? So I think that's worth exploring further. Thank you.
All right. So I want to be mindful of time because it's already 17 minutes past noon here, and it's 17 minutes past 2 a.m. for Carole. And I think we should, unless there's any pressing questions, I think we should let her go now, so that she can get some sleep. And we're really most grateful to have had you, Carole, and that you gave us your time in the middle of the night. So thank you for that.
Thank you very much. I
I
really appreciate the opportunity and appreciate all of the feedback. Thank you very much, everyone.
Thank you.
Thank you.